We can get started. It looks like the number of new attendees has stopped going up. So thank you all for joining us. I'm Sam Ozek, and we'll welcome the December Public Policy Lunch featuring Rob Nichols, the President and CEO of the American Bankers Association. Our WHF member colleague, Holly Smith, will introduce him more, but I just wanted to give you a couple of administrative notes. Today's session is being recorded, and so if you object to that, then don't put anything in the chat function. Rob is going to have a discussion with WHF board member Tilcia Toledo, and after that, then we will take questions from the chat or the Q&A function at the bottom of your screen. In terms of a couple of upcoming programs, we have the Professional Development Committee meeting on the 15th, talking about career transitions. We have our annual holiday fundraiser for the foundation on the evening of the 17th. And right after New Year's, our next lunch and learn is on the 5th about cannabis, banking, or the lack thereof. And with that, I'll turn it over to Holly Smith. Thank you both.
Thanks, Sam. Hi, everybody. Happy holidays. Very excited to introduce our two panelists today. Rob Nichols is the president and CEO of the ABA, where I work. ABA is about a 140-year-old organization that represents banks of all sizes and charters and is the voice for the nation's $20 trillion banking industry. Rob has a pretty extensive bio, but would probably be embarrassed if I went through it all. He joined ABA in August of 2015, following 10 years at the helm of the Financial Services Forum, which many of you are familiar with. He served in the George W. Bush administration as the Assistant Secretary for Public Affairs at the Treasury Department. And in this role, he acted as a chief spokesperson and head of the Office of Public Liaison, serving as Treasury's lead representative with the media, business, professional trade organizations, consumer groups, and the public. Good training for his current role. Rob's a recipient of the Alexander Hamilton Award, the highest honor the Treasury offers, and he's also consistently ranked as one of Washington's top lobbyists by The Hill and many other publications. On top of all this, Rob is the current chairman of the IB Fed and finds time to volunteer as a board member for several notable area organizations. So we're grateful that he volunteered for this opportunity today. And our fireside chat moderator is Tilcia Toledo, and she's managing director in the financial services practice of FTI Consulting. Based in DC, Tilcia specializes in risk management, governance, and compliance. She leverages more than 25 years of experience in investment banking, regulatory compliance, and consulting, and delivers valuable solutions to financial institutions. She's a Women in Housing and Finance board member, as Sam mentioned, and so I'm happy to turn it over to her. Thank you all.
Thanks, Holly. And Rob, welcome to our fireside chat. I am super excited that we get a chance to chat with you. I know we only have an hour and we have a lot to cover. So I want to go ahead and dive in, and as Sam mentioned, for folks who have questions, please put them in the chat. I'll make sure I get to them at the end. But for now, we're just going to do a Q&A session in terms of the format.
Sure.
So Rob, why don't we start with COVID? We know that we're in the middle of a pandemic. Everybody recognizes that as we came into 2020, the banks were in a better financial position from the standpoint of their assets and their balance sheets and how they were capitalized versus the 2008 recession. Mm-hmm. Can you give us a sense for how our financial institutions faring during the pandemic right now?
Sure. Thank you, Tilcia, and to Sam and Holly, thank you as well. And Women in Housing and Finance is a group that have long been associated with, and so just thank you for the invitation. Really appreciate it. Right. Unlike the 2008-2009 crisis, banks were here this year, this calendar year, have really been part of the solution, not part of the problem. And due to the legislative, regulatory, and industry initiated changes over the last 10 years, the sector's really come into this healthcare crisis with an economic tail, as in a position of strength. The sector has held up quite solidly. Obviously, it's not a monolithic story, but net, the banks have been playing a critically important role. First, pre the CARES Act, reaching out proactively to all their customers, clients, and communities to try to keep people in their homes, try to keep small businesses afloat, and work with their borrowers. That was all proactive outreach on the part of the sector. And then, of course, post-CARES Act, the role of the sector, I think, has been dramatically defined by the implementation of the PPP, the Paycheck Protection Program, which we can talk about in greater detail. That was really a bank story. Roughly 90% of the lenders associated with that program were banks. The overwhelming majority of the loans were delivered by banks of all sizes, from GSIBs all the way down to the smallest community banks, as well as regional and mid-sized banks. So this has been I think, a really important year for the sector to really try to play an outsized role working with the public sector to help address the massive economic dislocation associated with the economic downturn resulting from COVID-19. So it's been a huge year. The sector has been doing, really historic stuff. I've been proud to serve this industry and lead the ABA during the last 9 months, where I think we played a very positive role in helping address this massive economic dislocation associated with hopefully once in our lifetimes, global pandemic.
Yeah, I mean, at least we're seeing some light at the end of the tunnel, right? We're getting some good news about the vaccines, and also there's talk about this potential second act as it relates to additional relief. Let's unpack things a little bit as it relates to where we are, right? It's December 10th. We've had our elections, so we know, for example, that we're going to have the Biden administration coming in. We know that the majority that the Democrats had in the House has diminished a bit. The Senate is up for grabs, though, right? So we have the races that are coming up in Georgia. Let's talk a little bit about how who controls the Senate can impact how we look at the financial services industry. And there are various different scenarios. So I know we have a lot that we need to cover there. So why don't we start out with, the fact that we could have a situation where the 2 seats go to the Democrats. So you have a split House, 50-50. Sorry, you have a split Senate, 50-50. And, the VP has the breaking tie vote. What is it that you think the impact would be in that kind of scenario?
So that would be that. Yeah, that's a very different scenario, certainly, than Republicans holding it. And I'd surface kind of 2 key top lines that would be interesting to speculate about. One would be with a Vice President Harris being able to break any tie, should there be any ties. We'll first talk about the policy piece. I think you could see a significant corporate tax increase. You could see, the contours of a Green New Deal. You could see some significant healthcare changes, with, I think, the fiscal adjustment being, a very significant matter that could occur through budget reconciliation, I would imagine. So you'd have a policy direction, Telsia, that I think would be rather different than if the Republicans controlled the Senate. If you had to ask me, number one, on a host of policy outcomes, particularly on the fiscal side, if I had to guess, I think that's something you would see in 2021 right out of the gate. On the personnel side as well, I think some of the potential candidates for future Biden administration positions might be a little more potentially progressive than they would otherwise if there was an easier path of Senate confirmation. I do think most of President-elect Biden's nominees will make it through anyway. There might be 1 or 2 that have some tough battles. I do think the majority will make it through the confirmation process. But if it was a Democratic-controlled Senate, I think the underlying orientation of the nominees could be a little more progressive than you would otherwise see. But those are the 2 key takeaways if there is a Democratic-controlled Senate or a 50-50, and that would be both the nominations process would be very different than if Republicans controlled it. And I think the areas of public policy that you're likely to see, move through the Senate, I would even say perhaps swiftly, would be quite different than if Republicans controlled it.
So let's talk about the other scenario, right? In terms of the scenario where the Republicans get 1 or 2 seats and then they have the majority. How do you think that changes what we look at from what we would get from the Biden administration?
Sure. Well, if just again, we're assuming here today, we don't know what's going to happen on January 5th. We are, as it's publicly been reported, we have ads up in Georgia right now supporting Senator Perdue, who is on the banking committee. So we have ads that the ABA is paying for right now running in the state of Georgia. But I think if there was a divided legislative outcome, which again, for speculation purposes, again, the nominations, those up for nomination for the various regulatory and cabinet level positions get a tougher degree of scrutiny. You're not likely to see a big corporate tax increase. You're not likely to see, the Green New Deal or some massive healthcare overhaul. If I had to guess, what does that mean, Telsia? Directly to your question, it means it would require anything to be bipartisan to make its way to the president's desk. So to go through a McConnell Senate, a Pelosi House, to go to a Biden White House, it would have to be bipartisan. Now, there's two schools of thought here. There's school of thought A, that McConnell and Biden have had 30, 40 years of working together, and they'll be able to, come up with some high-level bipartisan agreements on a handful of things. I'm an optimistic, glass half full person by nature, so that's the hope. That's what I would hope to see happen, is the history of deal-making might continue in a handful of areas. The other side of the coin, the more pessimistic, negative, some would say realistic side of the coin, is that no. The two sides will entrench, and you'll have, very polarized government for another series of at least for the first 2 years of President-elect Biden's upcoming 4-year term. I would hope that there could be some bipartisanship. I really do. I would note that when Joe Biden was the vice president of the United States for a number of years, he was dispatched by President Obama frequently to deal with the Republican leadership in the Senate to cut deals. Obama did not like, former President Obama, that was not his cup of tea. That's not what he liked to do. Of course, he had to on occasion. But generally speaking, Joe Biden was at the table dealing with the House and Senate Republican leadership on budget deals and other very significant areas of policy. So there is a scenario where you could see bipartisanship. I certainly hope that would be the case. You look at addressing our long-term finances. We've part of the COVID response, as you well know, has been to spend a heck of a lot of money this year, $4 or $5 trillion. So our debt and our GDP are now, as you know, roughly equal, and that's where things get a little dicey for any major industrialized economy. So, one area of potential bipartisanship is to think about how do we address this massive long-term debt. That's a huge issue. That's number one. Number two, immigration reform, I think, is another issue that has the potential for bipartisanship. So yes, could things be very polarized and very political very quickly? Sure. But is there a chance with a Republican Senate, a Biden administration, and a Pelosi-led House that you have some bipartisanship? There sure is. And we'll see if that can happen. We will certainly push for that. One last thing, and I know it's a long answer, but when you look at the last big banking reform bill, 2155, I would note that that was a bipartisan bill. And that was bipartisanship returning to our issues, because our issues, all major banking bills, as you may know, for going back almost 100 years, with the exception of Dodd-Frank, were bipartisan. And we finally returned to the norm. Dodd-Frank was the exception. 2155 reverts to norm, where banking bills are bipartisan. We want to make banking bipartisan again, because the intermediation of capital and the deployment of credit, it's not a Republican event or a Democratic event. It's an economic event, and it's in everyone's interest for our economy to, for us to spur the economic recovery. And so I hope we can do that with people on the left and the right.
So let's talk a little bit about a couple of things that you touched on in that answer. One is, we know that there's the new $908 billion bill that's being talked about. So can you put that into context in terms of what do you think happens as it relates to that bill? And also, are there additional facilities that you're expecting to see, whether it's that bill or a future bill? Because what we heard, especially from the Biden administration, is that they view this as a down payment, that they expect more. Mm-hmm. And we also know that we're going to have, hopefully, future Treasury Secretary Yellen at the helm. So, so in terms of those various different moving parts, what do you see happening with the next wave of the bill? And is it really just a down payment?
So a couple of things. One, on Yellen, I do think that was a smart pick and nomination on the part of President-elect Biden. I think she gets confirmed easily. And I think the harmonization of fiscal and monetary policy will be strengthened next year with her at Treasury, the old agency I spent many, many years in. To the bill being discussed in the lame duck directly, I hope that gets done. I am encouraged that if it doesn't get done here in the next week or two, I do think you'll see a legislative remedy in the first quarter of next year. So I don't think it's a matter of if, I think it's a matter of when. And we think the economy is primed and does require additional fiscal stimulus. You've had people both on the left and the right, as well as CEOs of large financial organizations have made that point. You've seen Jamie and Brian have made that point. Jay Powell and others have, and I'm aligned with that view that I think there should be. What the exact contours are, Tilcia, we're not sure exactly, but the things that they're talking about, streamlined PPP forgiveness, we're totally supportive of that. We think we probably want to clean up the existing forgiveness of those 5 million plus loans that were always intended to be grants. But I think if we could address that before we start talking about round two, we think that's important. But if there's additional PPP money that's either for a general pot or directed more specifically, we think that makes sense as well. The idea of having EIPs in there, individual payments for families, I think that makes a lot of sense. And then the rest of the contours in terms of liability or state, local, we'll let those, the two parties work that out. I think it gets done. It's hard to predict if it'll get done here in the immediate term or if it gets done in the very beginning of Q1. But I do think all focus next year is going to be on our nation's economic recovery, full stop. And so I think you could see something get done right now. And then I think you would likely see in Q1 or Q2 another bite at the apple, so to speak. And listen, we're the largest economy on the globe. We need our economy to continue to create economic output so we can keep Americans working. And if we have, if our economy really sputters, that has global impacts, as you well know. And so I think that having the incoming Biden administration work in a bipartisan way with Republicans in the Senate, obviously with Speaker Pelosi's leadership, so that we can, right this ship, I think that makes a lot of sense. If you would have asked me, 2 weeks ago, do you see a likelihood of something happening here in the lame duck? I was a little more pessimistic. Obviously, over the last 24 hours, we've had some smoke signals that are a little more positive. They are, and will that mean that we get something done? We'll see. Who knows? But I do think something will get done. It's a matter of, is it a December event or a Q1 event? And I do think it will happen. I think it's when, not if. And the idea of having this being just a down payment, I think that we have no objection to another legislative remedy, another relief vehicle coming next year.
Okay. Let's talk a little bit about the heads of some of the key agencies. And I'm curious to kind of hear your thoughts, right? I mean, there's some that we know are not going to change. For example, the chairman of the FDIC is not going to change, but there are others that, could move around. Do you have any specific thoughts? Especially I'm thinking CFPB, OCC. Do you have any specific thoughts about those and what you're thinking about that may happen depending on who leads them?
Sure. So I do think your assessment is aligned with ours that Jelena McWilliams will remain at the FDIC through the duration of her term. She may be a minority member of her board, which will make for some sporty meetings, I would imagine, but she's up to the task, in my humble opinion. So I think she stays. I think the leadership at the Fed will remain through their terms, Jay Powell, Randy Quarles, et cetera. So I think those two entities will remain largely intact and won't be subject to significant change until the terms expire. To your point, I absolutely do believe you'll see new CFPB leadership. It's likely there'll be someone appointed as an acting, interim sort of person towards the beginning of the year, as someone has been nominated by President-elect Biden. We'll see who that is. But I think we'll see new leadership there. And then certainly I believe you'll see new leadership at the OCC as well. And then I think those two are rather kind of cut and dry, if I had to guess. I think the one that has a little more has a question mark around it will be the tenure surrounding Mark Calabria. Obviously, there's a Supreme Court case that it's been reported will be decided as potentially in June of next year. So it's quite possible you'd see Director Calabria there till middle of 2021, until I think the Biden administration may want to look to that court case, the outcome of that court case, excuse me, to make a judgment on bringing a new individual at the helm there. But I think with regard to the banking regulators, I think you'll have static leadership at the Fed, at the FDIC. I think you'll see new leadership at the OCC, and certainly new leadership at the FDIC. What does that mean for our industry? A couple of things. I think, as you know, major banking rulemakings often require the three banking prudential supervisors to do joint rulemaking. So the Fed, the OCC, and the FDIC on really significant pieces of banking policy work together. Since there'll be existing leadership at the Fed and the FDIC going into next year, I guess the key big picture takeaway is I don't think you'll see a massive 180 in terms of the regulatory architecture in the United States in January 21st of next year, for example. I think that will take a little more time. Will there be some immediate changes, for example, at the CFPB? Might there be an additional or higher civil monetary penalties? Might there be additional enforcement measures under a new CFPB director? Sure, absolutely, there might well be. But apart from that, I don't think you will see a massive delta overnight that some have predicted.
Okay, no, that's helpful. I mean, speaking of CFPB, I mean, one of the things I want to touch on is that there's talk about the mini CFPB in California, which is what's being referred to, in some circles. And they're definitely going to, what they've added under their purview is is fintech as well.
Mm-hmm.
So I'm curious about your thoughts about the Department of Business Oversight, which will now become the Department of Financial Protection and Innovation in California. And what are your thoughts about what we may see from them? Should banks that are based in California be bracing for any additional fintech regulation? What are your thoughts?
Yes, well, we'll certainly get into fintech here over the next half hour because there's so many things happening there, particularly as it pertains to chartering. But I would just generally observe this. I mean, the states, and I'm from the West Coast, and my family's actually originally from California, so I can say this. Many have said Sacramento is a petri dish for bad ideas, and sometimes it is, and sometimes it isn't. That's the state of California. I grew up in Seattle. My family's from the Bay Area, though I grew up in Seattle. There are some progressive state legislatures on the West Coast right now that are doing a lot of interesting things. Why we monitor that so closely, Tilcia, and we have a group that monitors what's happening in all 50 states, is to see if the ideas get exported from one of the states and then brought here to be debated in the Congress. And that happens, as you well know, frequently. And it's not just Sacramento or Olympia. It can be other parts of the country where there's a particular idea, and then that you see in one state, and then it becomes national. So what the future of California will be, we have a lot of members in that state, and a number of which are not actually contemplating, or at least the ones I've talked to haven't contemplated actually pulling up stakes and moving their headquarters to other parts of the West Coast. But I will say that there, a number of the steps and actions of measures that have occurred in some of the states on the West Coast have made it hard for many types of industries to do business there. In my home state of Washington, a lot of states are fleeing next door and moving when they can, not banks, I'm talking about other industries, but a lot of industries from my home state of Washington are moving into Idaho for reasons because they perceive a more business-friendly environment in that state. Will that be the long-term result of what's happening in California? Too early to tell. But what we monitor most closely is if in any of the states, a particular state level action is something that the feds flirt with or view with favor, or want to learn more about.
And, just talking a little bit about like fintech and the things that are happening in the fintech space, the national charters that are being issued and applied for. What are your thoughts there?
So two-part, this from an ABA standpoint, we have a two-part kind of broad fintech strategy. The first part is actually working phenomenally closely with these new market entrants. We have kind of a division, Tasia, at the ABA, where we partner with fintechs. We spend a lot of time with them, particularly those that want to work with banks. And I'm not talking about the GSIBs. They have huge budgets and innovation labs and R&D executives that don't need our help. But after the very largest banks, we actually act kind of as a due diligence shop for the 5,000 community banks across the United States. So we spend a lot of time with the fintech companies who want to partner with banks to offer an enhanced customer service. Just by way of example, there might be 10 different companies that have a small business lending algorithm to allow a community bank to close a small business loan more quickly than they would otherwise. They all want to work with our members, and so we spend time and talking to all of them and kicking the tires and try to determine who's kind of best in class. And then we kind of put the ABA Good Housekeeping seal of approval on that company, and then market that company and make that company's offering aware to all of our members. So we spend a lot of time with that sector, with the fintech companies, large and small, ones you've heard of to ones that are in their very nascent stages. So we have that piece of our strategy. Then the second piece is the regulatory piece, to ensure that as our regulators look at these fintech companies, we have a balanced, level playing field. We're not anti-competition. Banks were fintech, in our opinion, before fintech was cool. When you look at remote check deposit and ATMs, all that stuff came out of the banking sector. So we're certainly pro-innovation. We just want to be careful and make sure, as the regulatory architecture changes, we're not adding an unlevel playing field, and we're not doing something that might over time, impair consumer protections. So specifically to your question, when we look at what's happening in Wyoming with the crypto charter and the OCC with these payments charters, we're encouraging the feds, particularly the Federal Reserve, before they were to grant access to the Fed system, to go slow. Let's be very deliberate, very careful here. These are entities that are not subject to consolidated supervision. They're not subject to FDIC oversight. They don't fit the traditional definition under the Bank Holding Company Act. So these are, before we allow all of these folks Fed access, we think there should be a kind of a thoughtful dialogue around what it means to be a bank or not be a bank, and what sort of duties, obligations, and responsibilities should exist. So, what's happening in Wyoming in terms of the administration of a crypto charter is now there's another, half dozen or 10 states that are thinking about doing something similar. So it's gone from this one or two things to popping up everywhere, which is why we're encouraging the feds to kind of go slowly, because we just have a lot of questions about these new charters. And again, we're not anti-innovation. Innovation in the banking sector and that rapid convergence of banking and technology is what makes our economy so dynamic and so fantastic. And again, we're working with these fintech companies extensively. So we're not anti-fintech at all. In fact, we're very supportive of these partnerships. But as it pertains to their regulatory access, we just want to make sure this is done slowly, carefully, deliberately, thoughtfully. And that's the message we've shared with the Federal Reserve.
Okay, excellent. Speaking of another state, let's talk about New York. So NYDFS, the New York Department of Financial Services, announced the first enforcement action since the cybersecurities went into effect in March 7, 2017. And so they've charged the first American title insurance company with violating 6 provisions of the cybersecurity regulation. And it went into a lot of detail. Just from your standpoint, what is the key takeaway from this action?
So I haven't read all, the full candor with you, I haven't read all the details of that one specifically, so I can't comment on that specific one. I will say, though, when we're talking about near-term legislative lame duck possibilities, the fact that there is, in the NDAA bill and AML BSA reform modernization, we're super encouraged by that, and do think that there when we look at just the broader AML BSA regime, there are room for enhancements and refinements and modernization. So I don't know all the details of that particular instance, so it's hard for me to draw a global holistic conclusion. But I will say that working with Vincent and Congress, the idea of improving how we keep bad actors out of the system is super important. But on that particular instance, I hadn't read the details yet, so I'd rather not comment. Sorry.
That's fair. That's fair. Now I have a couple of what I'll call rapid fire topics, right? That I just kind of like want to see how we.
Do I have one word answers or how do?
Oh, no. Rapid fire is my questions are rapid. Your answers can be as long as you need them to be, Rob. I want to talk about, because I mean, there's several other areas, like for example, sanctions, right? In the US, we use sanctions as a way to implement foreign policy, and sometimes it can be unpredictable. Do you have any specific expectations from a Biden administration as it relates to sanctions?
So great question. As someone who served at Treasury for 5 years when we stood up, the Homeland Security Department, which had took legacy pieces of Treasury, and someone very involved in the financial war on terror, 9/11, I have firm, sharp views on your question. So I think sanctions, first of all, have been historically very bipartisan. Generally speaking, with a handful of aberrations here or there, but generally speaking, economic and financial sanctions, I think, are a really important diplomatic tool. Before we use a drone and before we put boots on the ground, we want to induce another country to do things that we think are the right things they ought to be doing. Financial and economic sanctions are the right, very important diplomatic tool. So I'm a huge supporter and proponent of those sanctions used appropriately. And historically, there's been a history of bipartisanship there, and that those economic and financial sanctions don't swing like super wildly, like other parts of public policy do between administrations. Sanctions a little less. So I don't know exactly what to expect, but I will say that obviously Janet Yellen, who I do believe will be confirmed for that position, she understands the power of economic and financial sanctions, given her old positions. I would also say that a number of the senior leaders, both not just the civil servants, but oftentimes at OFAC and FinCEN, who are the areas within my old department that are involved in sanctions, oftentimes a lot of those people stick around between administrations. So there's a lot of predictability and historical memory there at those parts of the Treasury who are involved in financial and economic sanctions. And so that institutional knowledge remains. So long story short, I think these are important diplomatic tools, particularly as we're trying to incent or induce or punish countries because of something they are doing or not doing. They're important tools as a nation for us to have. And number two, generally speaking, they've been used pretty bipartisanly.
Okay, great. Next topic, and like I said, I'm going to switch topics around quite a bit here. M&A. So we've seen some recent M&A activity, right? SunTrust and BBT. There's also PNC and BBV. Do you expect this trend to continue in terms of M&A activity?
I think there will be absolutely, and we have nothing against M&A. I'm pro M&A if it's for the right reasons. What drives me bonkers is if you see bank consolidation because of either a regulatory reason or bad succession planning or something like that. Those when I read of stories of that nature that they couldn't deal with burdensome regulations or the succession planning wasn't what it should have been, those for me are concerning and troubling. But when it makes sense for two banks to pair up and they think they can serve their customers, clients, and communities better as in a new format, that's part of the American economy, and that's what makes our economy so dynamic and so important. But I do think with the lifting, obviously, of the SIFI threshold, from 50 billion up, I do think that incents, particularly in the mid-sized bank sector and asset class. I suspect there are probably more conversations, Chelsea, happening now than maybe 18 months ago with regard to bank CEOs in that asset class, because they see, maybe scale here might be our friend. We don't have a lot of branches in the same markets, and you're seeing, you obviously saw the PNC news. You saw First Horizon Iberia. I mean, there's a lot of stuff happening in that sector. And so there's really good reasons for M&A in the banking sector as well as other sectors. But there's really good reasons for M&A. But just as a side little asterisk, when it's because a bank is, subject to a regulatory burden that doesn't make sense, or they had bad, particularly on the community bank side now, there wasn't proper succession planning. That tears my heart.
And somewhat related, right? I mean, there's talk about on the other side of some Neo-Glass-Steagall Act coming back to life. What are your thoughts on that?
Yeah, I think Glass-Steagall is a solution in search of a problem. I really don't think the large banks are posing the sort of risk that the proponents of bank breakup suggest. These are institutions that obviously, very large, but play, I think, a critical, important role in the U.S. economy. I think we have 5,000 banks in our economy, and there's room in this dynamic marketplace, in this robust economy, for community banks, mid-sized banks, regional banks, and large globally active banks that have a lot of customers that need those services, across the planet. So I think the money center banks, all the way down to the community banks, there is an important role for each bank. And that's something I believed even before I got to ABA, and something I had been writing about and talking about when I was the CEO of the Financial Services Forum, just representing the GSIBs, that our ecosystem, in part, why it's so dynamic, is because this cardiovascular system of banks helping deploy capital and intermediate credit, do so both from very small banks to the largest banks. There's room for everybody, and I think these bank breakup measures that do, to your point, every 3-4 years, someone says, let's break up the banks. I don't think that makes any sense. And I think it's a solution in search of a problem.
Okay. Shifting gears again, student loans. We see that the federal student loan portfolio is 1.57 trillion or so, something in that neighborhood. That's outstanding. And there's talk about maybe forgiving up to maybe $10,000 as part of COVID-19 relief. And there's other discussion about student loans. Tell me, what are you seeing in terms of the student loan portfolio? It has grown dramatically. And so I'm curious about, what is your view about how some relief should be implemented into the COVID-19 relief thoughts, and how we should be looking at the portfolios overall?
Yeah, so the student loan debt burden in the United States, it's a huge issue. And I think we should probably separate it from the COVID debate, but it's really important. So right now we have about 1.7 trillion. We have, sorry, let me say can't talk right now. Sorry about that. So it's at 1.7 trillion over the next 5 to 10 years. That number, by many projections, is likely to double to $3 trillion. So it's a huge debt. It's one of the largest chunks of debt outside of mortgage debt in the United States. So it's a big deal. And having these kids graduate college with essentially a small mortgage is a problem. So we've been giving it a lot of thought to see, are there kind of free market ways that we can help incent the speedier pay down of the debt. So one thing we do to help at the ABA, for example, to attract and retain the best and brightest labor force, particularly the millennials. We were the first trade association to pay down the student debt of our labor force. So if you have student debt, you work for me, every month we'll pay it down. And that's part of our suite of benefits, just like a 401k or a 529 plan that we have if you have a baby when you work at the ABA. So for us, that's a way to attract the best people. So we've been thinking, are there other things private sector employers can do that can help incent the pay down of debt and also attract, the best and brightest workers, into the U.S. banking system? So we're thinking about some private sector ideas, number one, some of which we're implementing at the ABA. Again, I think we were the first trade association in the United States to do that. So putting aside the private sector, the role that there may be for the private sector to use tools to bring people, into their particular companies. I do think there probably should be a debate in Congress about this massive debt burden, the impact it has on those entering the workforce with these massive debt loads. It's very concerning. I don't know what the right solution looks like. We have been giving it a lot of thought, but I do have a lot of sympathy for, again, these kids graduating either university or getting an advanced degree and having $200,000, $300,000, $400,000 of student debt that takes them 20 years to pay off. It's heartbreaking in many cases. And, when you look at the aggregate economic impact here, they're spending, their money paying that debt down. The sooner that debt goes away, the sooner all of these millions of people are engaging in commerce and generating GDP for our country. So there is some incentive for us to figure out ways to pay that debt down more quickly. I don't know if forgiveness, blanket forgiveness, like some have discussed, particularly in the presidential campaign that we just completed, there were some of the Democrats who had some pretty radical ideas in terms of just snapping the fingers and all of that goes away overnight. I don't think that's probably the right solution. I don't know what the right public sector solution is, but I do think there are some private sector things that can be done to incent this speedier pay down, but not exactly sure what the right public sector answer should be. But I think this is exactly why we have elected officials to talk this sort of thing through.
Excellent. Climate change, right? I mean, we know that John Kerry is newly elected special presidential envoy for climate. And I'm curious about what do you think that means as we're looking at climate change for energy investment that financial institutions make and just overall, just the financial services industry?
Yeah, Tulsi, it's so funny. We had a board meeting of the ABA just yesterday afternoon, and we talked about this. And we talked about what role should the banking sector, the whole financial sector play in terms of financing the transition to a low carbon economy? What does that look like? We think there are probably some market-based principles that are sensible for the industry to consider for that transition. Obviously, as you think about the transition to a low carbon economy, what does that mean? There's accounting considerations that come into place. There's investing considerations. There's the transition itself. We want to help support jobs. So I think this is going to be a hot debate. Pardon the pun. I didn't mean for that to be a pun, but I think this will be a serious debate and an important debate that will occur over the next several years. It's already thrust upon us, as you well know. So, but with Biden winning the election, as he did, that will put additional focus around climate. And we're trying to think creatively and expansively and thoughtfully at the ABA, again, working along with all of our financial sector peers, what's the role that the financial sector can play during the transition in a way that is, certainly, supports jobs. We don't want to see massive job destruction, particularly given COVID. So we're trying to think what constructive role can the financial sector play? We certainly don't have all the answers, but we've been giving it a lot of thought. And I'll credit, I don't know if anyone from this trade association is listening today, but IIF, under the leadership of a good friend of mine from Treasury, Tim Adams, has been playing a really important leadership role in terms of organizing the various trade groups just to think about what we can do and the role that we can play collectively. Obviously, each trade association, from SIFMA to the ABA and kind of everyone else in between has been thinking about this for some time. We have an ESG working group at ABA that's been around for a long time, so it's not a new issue for us. But we are thinking about how we can position the banking sector as a tool or an asset or a resource as this debate becomes more fulsome.
Okay. Diversity, equity, and inclusion. And, when I think about this topic, I think about it from two sides. I'm sure there are others, but I think about it, one, from the side of the consumers, right? The financial services consumers, making sure that they have access. And then also I think about it from the standpoint of management, senior leadership at financial institutions. I know that there's talk about the CRA and how diversity and inclusion intersects with some changes that are being talked about as it relates to the CRA. Curious about, whether you have any specific views on that, and then also just, on the second one, what does the financial industry need to do, right, to more accurately reflect the makeup of the United States?
So that's a great question. I'm so glad you asked it. We have a kind of a 3-part strategy around DE&I, and I'll take a minute on each part. And I'll say too, that this is not, many people started thinking about DE&I issues, post the death of George Floyd on May 25th. That is not the case here. When I started at ABA, I formed a DE&I task force about 4 years ago. That has spent a lot of time focused on this issue, making a series of recommendations of action steps and measures. And it's manifested itself, to see it in the following 3-part strategy. Part 1 is to support economic policies that address economic inequality, which in part, not fully, but leads to some of the racial inequities. So we have a team of people led by Diana Banks, who's actually out on maternity leave right now, but that is thinking of what can we do from a public policy standpoint that addresses economic inequality that leads to these in part to the racial inequities. So we have a whole squad of people working intently on that. One of the things that came out of that is the Bank On initiative, where we encouraged, every bank in the United States to offer a Bank On certified account so that those who are unbanked or underbanked can be part of the banking system. There's a whole host of other ideas there. The second part of the strategy is a member-facing strategy. So I hired about a year ago, maybe 18 months ago at this point, a woman named Naomi Mercer, who played a senior DE&I leadership role in the U.S. Army. She's now our head of DE&I at ABA, reports to me, direct report to the CEO. And what she is spending her time doing is working with the 5,033 banks in the United States so they can establish their own DE&I plans, programs, protocols. Now, of our nation's banks, some have highly sophisticated DE&I plans. I mean, frankly, far more sophisticated than nearly of any other industry sector. So there are some that are super far along on their DE&I journey. And then we have some, though, of course, who are in the early genesis stages of their DE&I, learning path. And so for those banks are reaching out to us, say, hey, how do I stand up a DE&I plan? What does that look like? So Naomi Mercer and her team are working with the 5,000 banks in the US to help them either augment what they're doing or establish and stand up a program. So that's the second part. The third part is an internal facing plan. I hired recently a second DE&I executive. Her name is Jasmine Cooper. She was the head of DE&I at Steptoe, the prominent law firm here in town. And what she is doing is leading a strategy on focused inwardly at ABA to ensure that ABA has the best in class DE&I practices and protocols of basically any trade association around. And I'm very proud of the path that we're on, the direction that we're going. We want, of course, not only do I want ABA to look like the customers and clients of the banking sector, but ultimately that's what we want the labor force of our nation's banks to look like, the customers and clients that we serve every day. Our internal story is a good one. We have 40% of our employees are non-white, 25% are or 40% are people of color, 25% Black. My senior management team is comprised primarily of women. So the bulk of the senior positions at the ABA are held by women. We have more to do, farther to go, and we're certainly not complacent or resting on where we are. But we have that 3-part strategy in place to address economic policy that leads to racial inequities, to work with the 5,000 banks to help each of them stand up really a world-class DE&I program. And then third is we want to ensure that we're walking the walk internally at ABA as well. So it's a really important issue. I think from a policy standpoint, it'll be really interesting. I think you'll see, we talked earlier about the CFPB and what a new Biden CFPB might look like. Another tangible piece here, I think it's possible that you'll see additional reporting requirements from the CFPB with regard to women or minority-owned businesses. What does the lending look like to those businesses? I think we'll probably see additional reporting requirements there, if I had to guess, from the CFPB. So I think you'll see the Feds thinking about this issue as well. Obviously, Chair Waters has had a number of hearings on this issue. We have worked very closely with her. The aforementioned Naomi Mercer has testified before the House Financial Services Committee. But we're deeply part of this, and I think it's a critically important debate. And we look forward to working with folks in both parties on the Hill, as well as the regulators, as they think about what role they may or may not play. But we've been playing a pretty significant and fulsome role with our members, and particularly those, who say, "Hey, listen, I want to stand up a DE&I program. What are the initial steps I should take? How do I go about doing that?" And so we're playing that kind of back office role for them, so that they have someone they can turn to who can help them on that journey and down that path.
Well, thank you. I mean, I think thank you for kind of going through those three parts. I think that's very helpful. And naturally, we all know that what you measure grows, right? So it's important to make sure that we're measuring all the right things. I am going through my list, and I just want to encourage folks that if there are any outstanding questions that people have, please feel free to put them in the chat. I am looking to see if there are any other big topics. Cryptocurrency. I mean, we talked about fintech a little bit, but we didn't really touch much on cryptocurrency. And I know that there's been some talk about a new crypto regulation that may come out from Comptroller Brooks before the end of the year. Any thoughts on that?
So yeah, I get asked a lot, cryptocurrencies, do you think they'll replace the dollar, the RMB, the euro? What about Bitcoin? I just don't. I mean, near term, I just don't see cryptocurrencies replacing the global denominated currencies that exist today. There's three, again, major currencies used globally, the dollar being first among equals there, obviously. I don't see crypto replacing that anytime soon. Obviously, I can be mistaken, but that's my best instinct there. And then one thing we've dialogued with the regulators about is just the consumer protection piece. When consumers, are they holding this as a asset? Are they using it to actually, for commerce? What does a consumer protection architecture look like? These are the sorts of questions. Is this just a novel financial investment, or is this, something real? The bottom line, who knows what the answer to that question will be. The bottom line needs to be, what will the consumer protections look like? It's a conversation we had both with Richard Cordray while he was still at the CFPB. We've had it with Craniger. We'll have it with whoever replaces Craniger, replaces Kathy. So we'll see. But my gut instinct is that I'm not worried about crypto replacing the dollar anytime soon. The Fed, of course, you've seen a lot of dialogue around central banks across the globe, what role they may or may not play. I think it's a little early it's early innings to make a hard prediction. But I think the most important lens for regulators here overseas to look through is the consumer protection lens. I think there's more questions around crypto than answers.
Got it. Okay. And Rob, I see we do have a couple of questions in the Q&A box, and I am just going to pick one of them, because I know we kind of have 5 minutes to go here. What do you think will be the fate of Fannie and Freddie?
So great question. That may take our last few minutes. So we're, like everyone else, we support, I shouldn't say everyone else, an orderly end of the conservatorships, but maybe doing so before the 20th of January I think there's probably more risk in doing that if to try to rush the exit. And without speaking for the other groups in the housing finance space, but we do work very closely with the mortgage bankers, the realtors, and the home builders. And I want to express my appreciation and gratitude to those three groups. The four organizations have been very closely aligned on this issue. Ultimately an end of conservatorship, I think, is the right direction. I think trying to rush it probably isn't, which is kind of a hot debate right now, as your astute audience will know. But I want to give credit to the, particularly Bob Brookschmidt at the mortgage bankers and the realtors and the home builders. We've had a really good partnership as we think about the future of housing finance. So we'll see. So I think there could be an end of conservatorship. I don't think it's probably between now and the 20th of January.
Okay, excellent. And I know we're running up against the hour. I still have quite a few other topics. We didn't talk about cannabis. We didn't talk about a couple of other things. So Rob, this may mean that at some point we may need to kind of like do a part 2 and have you back. But definitely just appreciate your time. Thank you for spending time with us today. You know, we just look forward to what happens now in Georgia also, right? And seeing kind of like, well, what do we end up with?
That's right. Well, one thing, I just see Bert's thing pop up. So, I mean, we do need to modernize the broker deposit rules, revise the national rate cap calculation. So we're totally supportive of that. Will we get something done in the lame duck? Probably not, Bert, but we're going to keep pushing both on the legislative side and on the and continue to dialogue with the FDIC on that issue. And you're right, Telsia, the Georgia outcome will be really telling for not just policy around banks and whether or not there's a corporate, a big tax increase, but that will impact a whole bunch of legislative outcomes if we have divided government or one party control. So we'll see. I really appreciate this organization. It's one I'm very familiar with. And Sam, thank you. Telsia, thank you. Holly, thank you. And for all the folks who took time during their lunch hour to hopefully wolf down a sandwich and listen to me ramble on, might have found a kernel or two of usefulness, but I really appreciate the opportunity to share some thoughts with you today.
Thanks, Rob. Thank you, everybody, for joining us.